In this video, I'm going to cover the statement of shareholders' equity. And if we're just meeting, I'm Casey, an accountant at a Fortune 200 company, and get those flashcards ready because I'm about to read you some super boring textbook definitions that you need to write down and come back to. And once we get those out of the way, we will look at a real world statement of shareholders' equity from Ulta, as always, and I'll march you through it. So, like I said, flashcards and a pen.
Statement and equity. Okay, this is one of the face statements listed in the 10K. And equity. What is equity? In the most simplest terms, equity is what is left over for owners after a company pays its debts.
Section 1, I'm going to give you the overview of the statement of changes in equity. So what is the statement of changes in equity? The statement of changes in equity provides valuable insights into how shareholders' equity has changed during a specific period. It details movements into two main components, paid in capital and retained earnings. Paid in capital represents the total amount that shareholders have invested in the company. When investors purchase shares, they are essentially buying ownership in the corporation. The number of shares they purchase determines their percentage of ownership, i.e., if they buy more shares, they have a bigger slice of the pie. In this case of Ulta, the type of ownership presented by shareholders is known as common shares, but we're going to get there. Section 2, paid in capital changes. When a corporation sells shares to investors, it is said to be issuing shares. This increases paid in capital. In the statement of changes in equity displayed on the screen, you can see that paid in capital has a beginning balance of, say, $100. During January, the company issued additional shares worth $200, which increased total paid in capital to $300. See? Easy peasy. Section 3, retained earnings explained. Now, retained earnings represent the accumulated net income a corporation has earned over its lifetime, minus any distributions to shareholders in the form of dividends. Dividends are payments made to shareholders from the company's net income. Generally, shareholders have the right to receive dividends based on their ownership percentage. Section 4, changes in retained earnings. So to better understand retained earnings, I'm going to show you Ulta's activity. As you know, this company has been in business for some time. In this specific example, we're going back to 2020 and working our way up to 2023. Now, I don't want to completely bore you, so I'm going to keep this really easy and we're just going to march through 1 year. So let's look at the bottom at the ending balance of January 29th, 2022. You can see Ulta's net income, stock comp, stock options exercised, and other awards, the purchase of treasury shares. We haven't gone over that today, but I will in another video, and the repurchase of common shares. Now you can see how these transactions either increase the balance or decrease the balance in the consolidated statements of shareholders' equity. Now, think about how retained earnings will look for future periods. Say Ulta had a beginning balance of $200 and then they reported dividends of $50. So now we're down to $150. And then the next year they had income of $200. You're up to $350. So write it down. Beginning retained earnings plus net income or net loss minus dividends. Over time, retained earnings will continue to change due to new net income or losses or dividend distributions. And that is how the statement of changes in equity works. I highly advise for you to spend some time here and take a look at your favorite company's statement of changes in equity because it will make it easier to take a concept and put it into a real world example. And if you're a little bit interested in learning more a little bit about accounting basics, I highly recommend you picking up my very short ebook from Amazon.